Exclusive interviews with the world's most influential market leaders and rising entrepreneurs. This is the Rocco Farino Show on the Business Connection Network. Today on the Rocco Farino Show.
That you want to leave more value in a community than you take back out. Because if we're supposed to be impact investors, right, then whoever we're calling the beneficiary should in fact be the primary beneficiary.
I'm so happy to be here with Morgan Simon. She's an author, speaker, activist, and investor responsible for influencing over $150 billion in the social impact investing space. Morgan, welcome to the show.
Thank you so much.
So you wrote the book Real Impact, and from the get-go you mentioned two important words, transformative and palliative. Can you tell us why these words are so important to impact investing?
Sure. So impact investing in general is often defined as the practice of trying to put your money where your mouth is, right? To invest in things that reflect your social values, and that there's all different types of solutions. And just because you invest in a sector or geography, right, agriculture in Africa or renewable energy in the South, it can be done in a way that's transformative, meaning really addressing the underlying structural problems and fixing it for the long term, or what I would call palliative, which is a word we're used to knowing in the context of palliative care, right, which typically means making sure that someone is comfortable before they pass away. And essentially, if we are, simply decelerating climate change but not actually stopping it, or just making it slightly less miserable to be poor, I would say that's a form of palliative care, right? And that we really want to do what we can as investors to be as transformative as possible to address the root causes and really make systemic change.
Right. So transformative is more, getting involved in making sure things actually change for the positive rather than just painting a picture of positive over what you're potentially investing in. Is that about?
Right. So for instance, that there's been a number of solutions that are about how do we replace the payday loan industry, right? That so many people pay massively high interest rates just when they need some extra dollars to fulfill basic necessities. And you could certainly create a cheaper loan product, but you could also be really considering why is it that people can't pay their utility bill at the end of the month? And it's not that poor people are bad budgeters. They're simply not paying enough, right? So how do we create enterprises that actually follow living wage scales so that everybody can get their needs met and not need to have a loan at whatever price towards the end of the month? So that's what we're looking at, are we making it easier to be poor, or are we actually stopping poverty? And I think that's the opportunity that we have with impact investment, while also fulfilling financial goals, right? I think that's the exciting piece for people who are new to impact investing. We're used to thinking that if you want to make social change, you have to just give money away. But with impact investing, you can make a financial return through an investment in a for-profit business, but a business that's taking care of its current needs, that's watching out for the environment, that's really trying to create a much brighter future.
And so the investors who are engaged in impact investing, are they seeing what type of returns would you say as a percentage relative to the stock market?
So what we have found, and from fairly traditional institutions, right, from whether Deutsche Bank or Harvard Business Review, numerous studies showing that businesses that take care of their employees and the environment actually do better on the market. So for instance, a Harvard study had shown that over 18 years, companies that had higher social and environmental value had doubled the market cap. So really substantial difference in terms of the value they're creating. And that's in part because, particularly for people who are long-term horizon investors, if you're, not looking to retire this next quarter, you're looking to retire in 20 years. Well, that means if a company only has 10 years of oil reserves, that's a problem, right? That we really need to be looking out for sustainability, not just from the frame of wanting to protect the earth, which certainly motivates some people, but also protecting our retirement, right? Of knowing that we need to invest in things that are going to be around for those 20 years. And I believe that's why we see these companies doing so much better, because they're really preparing for a long-term reality.
Right. And with that, how would you define impact investing? Like, what's a good definition? Because when you search the internet, it's like this repetitive mission statement where I don't think a lot of people could actually visualize what it actually means.
So it's defined as an investment that has the intention of making a social or environmental impact. That's the definition that will be provided by the Rockefeller Foundation, and kind of initially termed the impact investing, coined the term, pardon me. And I guess it goes back to, though, when you look at the Merriam-Webster definition of impact, to impinge upon, especially force, goes back to the idea that impact can be positive or negative, right? That it's an intention, an expressed intention, but that it's up to us as imperfect human beings to make sure that we get it right. And that's why sometimes we can be a bit skeptical or see some challenges when you have people on the 40th floor of Wall Street saying, okay, we're going to move into impact investing, we'll figure out how to change the world, without really having that grassroots connection and accountability to make sure we're actually doing things that people want. So as much as there is a lot of good intentions around impact, there's also a lot of concern about impact washing, right? Of what are the questions that you have to ask to make sure that the impact is real. And that's part of why my book is called Real Impact, right? It's the idea that, yes, there's real impact to be had, but that we actually have to make sure that it's real.
Right. Would you say it's like the Warren Buffett meets Mother Teresa of investing?
I would even say, Warren Buffett at one point was asked while speaking at a business school, should you make a bunch of money and then give it away, or should you do some type of social business from the start, right, and express your values in whatever you do? And to the prior of the idea of, make the money now and give it away, he said, well, that's kind of like saving sex for old age. And that's really not a good idea.
Right.
So I think Warren Buffett, in his heart of hearts, has shown this concern of, how do we really start to think about integrating our social values and having that Mother Teresa mindset. And then you've also seen his descendants, like Howie Buffett, really move deeply into impact investing.
Nice. Yeah, that makes sense. So you started 4 organizations. Could you tell us about your current project now?
Sure. So I've been doing impact investing for close to 20 years, and that's part of, over time, really trying to also build the infrastructure of the industry. And my current firm, Candide Group, we work with families, foundations, athletes, and cultural influencers who really want their money working for social justice. And we've done over 65 investments over the last 6 years in companies and funds, and our portfolio is over half women and people of color as well, so a strong diversity emphasis. And that goes as broad and deep as low-income housing, to solar for low-income communities, to worker co-ops, the types of businesses that you can be really proud to tell your grandkids about.
Oh, so what are some co-op investments that you've made inside the U.S.? What are some good examples?
So there's a fund called The Working World out of New York that supports co-ops all over the country. One of them is a factory called New Era in Chicago. It's the only minority-owned manufacturing facility in the whole state, and it does environmentally sustainable windows. And this was a case where a firm had bought a window manufacturer and was going to shut it down, even though the factory was profitable. It's that this family was struggling with their finances in other areas, and we're going to make these workers essentially pay for it. And instead, the workers came back and said, nope, we're going to buy the factory from you, and we're going to keep running it profitably. And that's precisely what they've been doing. And that's the sort of thing where we provided financing to the working world to then provide financing support to the co-op.
Great. That's an awesome example. Because you don't really see lots of local community banks or investors, helping to engage that type of investment for employees to take over the company.
You don't, and I think that's part of why, for those who are excited about getting into impact investing, it's really critical to find an advisor who actually knows the field, who is going to have a line of sight into those operations and into those opportunities. Because as they say in financial management, no one gets fired for buying General Electric. That often, if managers are not familiar with impact, they might say it's a bad idea, but it's often that they just don't have the relevant expertise. But what's great is that now within most traditional advisory firms, you can always even just ask to be referred to the social impact department and see what they already have on their platform. And if you're not impressed, it's the opportunity to push them to do more.
Right. Yeah, that was a great example. Did the employees of New Era reach out? Like, how did they find you guys, or did you find them? Because that's one of the reasons why I wrote my book is to help connect people who don't know how to raise money with investors, because they don't know what they don't know. How did the New Era employees, either did they reach out to you, or was it the other way around?
In that case, they had connected with the fund, with the working world, and that's part of, as investors, you can't be everywhere and do everything. So there's some deals that we do directly, and other times that we work through funds. So other examples of direct deals we've done recently was utility scale, or actually in process, utility scale solar on the Navajo Nation with a majority Native-owned entity is a project we're really excited about. And I guess I would say that at this point I've been in market for so long that companies that have that social mission will often know to reach out to Candide Group. So that goes back to, to be successful in the field, you really have to have the depth of connections to be in the pathway of these sorts of companies, or you're right, they won't know that you exist.
Right. That's nice. What would you say?
And that's also where, I was going to say that investor networks like Tonic, like Investor Circle, can be really helpful as well in helping to bring together deal flow and help individual investors find compelling opportunities. No,
that's good to know. What would you say the number one rule for social justice activism is?
Now, one phrase that partners in the Global South would often say is nothing about us without us. And the idea that it's very easy, whether in philanthropy or impact investing, for people to make presumptions about what other people in the world want. There's a really simple example. We presume that any community would want a well if they don't have access to a well, or running water in their house, right? But sometimes in a village, the women might say, you know what, that 2 hours a day that I get to go walk and touch the water is the one time that I get to hang out with my friends and nobody bothers me, and I would much rather do that, right? So it really depends case by case, and making sure that if you're going to do an intervention in a community, you actually have talked to community members about what they view as fair and proper. And that is a step that investors often skip, right? We're busy people, ability to kind of have time on the ground. So for instance, at Candide Group, we make sure that we do an in-person visit to any company or fund that we invest in. And that's both domestic and global. But we feel like if we haven't really gotten to talk to the people, then there's just no way to know if we're doing smart investing or not.
Yeah, it makes sense, because it's almost like creating a product or service without actually seeing if the customer that you are targeting would actually use it. So that's
exactly.
Good research.
I was going to say that one of the stories that I told in the book, right, was that an entrepreneur, when I'd asked how they tested their solution, which was a solar stove for consumers in the Global South, they noted that they'd gone down to Mexico to test it, but no one on their team spoke Spanish. So it was this question of, okay, you say you're doing product testing, but if you can't even understand what people are telling you about it, right, how is that possibly valid? So it really kind of takes a thoughtfulness and discipline to make sure that you really are getting that user feedback and not making assumptions for people. And then the final piece is that too often we're just treating people as consumers and not as the protagonists. And I think this is another really critical point, that part of why we have such incredible inequality is this divide between who are the owners and the entrepreneurs and the consumers. And the more that we can create opportunity for broader ownership, the more that we can really level the playing field. So that's something that we also look for a lot in our investments.
Nice. That's great. Now, I'm not sure if I know how to pronounce this correctly, but Swarthmore, is it Swarthmore, or how do you pronounce that particular?
Now, if you're from California, like me, you say Swarthmore. If you're from Pennsylvania, you say Swarthmore.
Swarthmore. Okay, so I'm
close. Would say Swarthmore. Yeah.
So as a student at Swarthmore College, what was the light bulb moment that went off in your mind where you connected the ability to leverage the school's $1 billion endowment to fight social injustices? And how easy or hard was it to convince the VP of Finance to make it a reality?
So I was an activist from the time I was literally in middle school and started running tutoring programs in Los Angeles, and then did a lot of work with homeless and formerly homeless children, and started to really see how so many problems plaguing families were really just an extension of the economy, right? Whether it was difficulty getting a job, having to deal with immigration status, with the challenges in securing affordable housing, right? It all kind of centered back on economy. And when I went to college, that got me really excited to look at what are the ways that I could think about my relative economic privilege, not that I was from a high net worth background, but the fact that, I was going to be a billionaire for the first and probably only time in my life, in terms of being connected to this institution. How could I really use that as an opportunity for social change? And I joined the school's Committee on Investor Responsibility. That was really my kind of entree point to the investment field, and was lucky to have in the administration people who were really supportive of the idea of students taking strong action. So we filed the first shareholder resolution since the apartheid era, asking Lockheed Martin to add sexual orientation to its non-discrimination clause. And after presenting at the meeting, they ultimately did decide to change that policy, and was kind of part of the wave that we saw of companies making these changes on their own leading up to national legislation. So really kind of part of that long-term social change effort. And for me, it was really this opportunity to see that as an individual, you could have power over a corporation, and that you could come together to really make a difference. So that very much inspired me, and then inspired hundreds, thousands of students across the country that came together in the Responsible Endowments Coalition, which at its height was over 100 campuses across the country, looking at the $400 billion that colleges and universities manage nationally. So just to end that point, I think we often, as individuals, if you might have $10 or $100 or $10 million or $100 million in your bank account, we tend to always feel like it's not enough and that we don't have economic power. And what I've learned is that we're all connected to money somehow, right? I call it being an accidental billionaire. That maybe it's your retirement plan, maybe you're a teacher that's part of a much larger retirement plan, maybe you're an alumna of a university, right? But that if you kind of do the mapping, you'll find that you're connected to numerous billion-dollar institutions, and then it just becomes the question of how can you leverage those connections to do something positive for the world.
Right. Now, was it easy, or was it hard to convince the VP of Finance to actually, go after a corporation? Because I would see someone from a university just not taking it serious, like they don't want to make waves. Did you get that?
It was quite easy, and I'll tell you why. One is that we made sure to pick an issue where the social and the environmental consequences, the social and financial consequences are so closely aligned, right? So the VP of Finance, their primary responsibility is to make sure that the school is solvent, right, and managing its funds well. And the things that companies were finding, given that it's more or less 10% of the U.S. population is projected to be LGBTQ, that if you as a company have a policy that basically tells those people that they should feel unwelcome, you're shutting out 10% of your applicant pool, right? For whatever reason that you might do it, right? But that is a poor business decision, right? For whatever criteria. So basically, as a financial steward, as a fiduciary for the school, he was very much behind the idea of we should absolutely make sure that companies are doing the best by their shareholders, And let's add to that the fact that we're a mission-based institution and that we believe deeply in the safety and security and rights of people, regardless of their sexual orientation, that both of those wound up being very deeply aligned. So from that perspective, they were really happy to do it. And we flew out to San Diego together to present to the board of Lockheed Martin.
Nice. And then you filed a shareholder resolution?
That's correct. So basically, if you own stock in a company over 2,000 shares for at least a year, then you can file a statement with the company basically saying, we don't like what you're doing about X, or we want you to change X behavior as long as it doesn't fall within what they call ordinary business practices. And then all the shareholders come together to vote. And it's a non-binding vote, but it is the strongest statement that investors can make, and it can be deeply embarrassing for companies because you're essentially notifying all of their shareholders that this company has a problem.
Mm-hmm.
So often, there's a time period between when you file a resolution when it comes to a vote. Companies will try to negotiate with you to essentially make the resolution go away before they have to send it out. And
Right.
that becomes an opportunity to really make some tangible change within companies.
So that's an important lever.
Mm-hmm. Absolutely.
Nice. Well, there was a section in your book that I personally connected with, and that was a story about you visiting a friend or an entrepreneur in downtown LA who raised about $500,000 from friends and family. And part of the driving force behind writing my book is to help close the enormous gap that exists between wealthy investors and entrepreneurs who have limited access to startup capital. Could you explain your experiences working in the United States? What struggles you have witnessed from entrepreneurs with limited access to investor capital?
Sure. So I believe this is correct, that less than 2% of venture capital has gone to Black or Latino people in the U.S. And under 10% to women. And that means that there is a massive lack of funding for certain populations. And there's often a presumption that even to get a company to the point where it could be venture funded is that you're supposed to have this round that they call friends and family. It's really quite laughable because for some of us, and the story that I told in the book was that I took one of my mentees, who's Latina, grew up in downtown LA, both parents extremely hardworking and scraping to get by in the U.S.,
Mm-hmm.
That when I took her to see this entrepreneur who was able to very casually say, oh, I raised $500,000 from friends and family, I know that if you walked up and down her block, these people love her to death, but she would maybe be able to collect $50, right?
Right.
That the idea that your friends and family would be able to get you enough money to start a company is pretty preposterous, right? And
Right.
it sort of makes entrepreneurship more of a privilege than a birthright, right? And we often talk about that talent is equally distributed by zip code, but opportunity is not. And that's why we need to be thinking more about how do we get people that first light risk capital that they need to even get to the place where venture capitalists would consider them.
Right. Yeah. So the part of my book, or actually most of it, is teaching men and women from opportunity zones or the most distressed cities in the United States, what they can do to prepare themselves to raise money, to participate in the opportunity zone economy now. And when I was growing up, I grew up in an opportunity zone, and that was my first business in 1999. Was a tech-related company. My town had a information technology zone, which stated that they were going to invest in a tech company or, to draw tech companies to the city. So I put together a team of myself and a couple Harvard graduates and a couple coders from India. Well, despite me only raising about $20,000, I still needed another 100. And despite we had the best business plan, we had a really good team, still couldn't raise $100,000, and that was my experience in trying to start a business in an opportunity zone or a distressed type of city. And there's not a lot of support, especially if you don't know anybody who's had a successful business, and if the opportunity zone doesn't have a good ecosystem set up, you're really going to start spinning your wheels and get frustrated. So that's how I connected with that particular story, because I was like, yeah, I was in the same situation. I probably couldn't raise $100,000 back then, and I didn't, but it was hard. And the point of the story is there's now we have this program where they're looking to get people to invest in opportunity zones, but we actually need deal flow to be able to invest in entrepreneurs. So they need to know how to raise capital.
Absolutely. Right. They need to know how to raise capital, but it's a two-sided market. It's also that investors have to learn how to look at businesses differently, right? So whether that's different ways of evaluating creditworthiness or experience, right? That you don't have to have an Ivy degree to be a really phenomenal entrepreneur.
Right.
I recently was talking to a friend from the low-income community who landed a job at Goldman and in the compliance department, right, which is very specific regulations, and you would presume you'd have to kind of come from a fancy school and background to do that work. But this friend of mine is absolutely obsessed with motorcycles. And the person who hired him said, when I heard you talk about motorcycles and that you clearly knew, memorized in and out every spec, every number, every letter, I knew you could do the same for SEC compliance. And it's really thinking about what are the comparable skills that a person can have, right? And how do you learn to evaluate that differently and give people real chances?
Good point. In your book, Gary Fields states that we have a global problem in that jobs that are created are precisely what are keeping people poor. What do both surveys and those who create low-paying jobs don't fully understand? Like what should be the correct key performance indicator?
Sure. So this goes back to, it's one thing to create a job, and that we often think about that as a positive force in society, but most working people, most poor people are working. So it's not just an issue of people not working hard enough, it's that they can be working even 2-3 jobs and still be poor, right? So it's really thinking about, if as impact investors we want to create real opportunities for people, we need to think harder about what a quality job means, right? That it's not just minimum wage, it's living wage, that it's providing health insurance, that there's retirement, that there's opportunities for advancement, like there's all these different pieces that, by the way, aren't just about helping people's lives, which is a great thing to do. It's also about having better workers, right? Of having people who are loyal to you, who are going to stick around for longer, that don't need to be trained. There's even, one study that's one of my favorites is that not only will employees steal less, but they collude less to steal, right? When you think of why even so much theft happens in things like grocery stores, is that people don't feel invested in the places they work. But when people feel like they are being invested in, they are going to have that loyalty, right? And it really shifts that dynamic.
Yeah. No, you definitely see that, especially with Starbucks, Costco, Home Depot. I think those particular publicly traded companies are heavily invested in their employees and actually look out for them. How can people interested in social impact investing build profitable investment funds without actually extracting too much cash out of the community? Like, how do you balance that?
So one of the principles that we try to follow is finance, which is the idea, very simply, that you want to leave more value in a community than you take back out. Because if we're supposed to be impact investors, right, then whoever we're calling the beneficiary should, in fact, be the primary beneficiary. So that's often a mathematical equation, right? That's really looking at what's the rate of return that community is receiving versus my rate of return. And I'll note that doesn't mean that I have to take a sub-market return, right? I just want to make sure that everybody in the transaction is being treated fairly. And it goes back to, my example about the payday lending and the interest rate. It's not just about making something better than the really terrible alternatives that we've had. It's how do you actually figure out what is fundamentally fair and structure an investment coming from that place.
Now, do you have any examples, even in the U.S., of any social investment organization that has been successful with not taking out as much out of the community?
Chicago, the New Era Cooperative, which I also profile pretty extensively in the book, that is under a non-extractive finance structure where the company has to profit before they pay back investors. And that was a way of making sure that if the investor is advising them to buy certain infrastructure or equipment, that they have to be equally invested in its success, right, and not just putting all the risk down onto the company and the owners. So through that sort of blended structure, you really kind of align incentives that the investors want to make sure that the company is as productive as possible versus what you've seen, for instance, private equity firms with Toys R Us, right, where they're really just extracting as much value out of a company as they can until they literally suck it dry, right? And the impact that had on thousands of employees across the country. So I think there's a better way to really create long-term sustainable investing returns and create value for families.
Okay, because in the long run, that's only it's only simple-minded, and it only makes very few private equity firms rich, and pretty much bankrupts a lot of other people, right?
Absolutely, and I mean, what's really amazing, when you look at whether the market crashes of 2008 or the fact that over the last decade, take out the top 3 firms and venture capital returns go to zero, that sometimes when people critique impact investment of saying, well, there's no way you could make as much money as traditional investing. Well, guess what? People aren't making that much money in traditional investing.
Right.
So it kind of points to this idea that something's not working in that system. And I guess, what is it? You can make any error once, but once you do it twice, you're a fool, right? What's that expression?
Fool me once.
The definition of insanity is doing the same thing and expecting a different outcome.
Right.
I feel like that's what we're constantly doing in the stock market.
Right. Yeah, no, that makes sense because, even with tech companies that are just blown up with excessive valuations, they're not filled with debt, but they're just filled with excessive equity. For example, WeWork, and because it's blown up with so much equity valuation, I just don't see it being that much of an impactful company, going down the road. So you're right.
And less than also security, right? That less than 2% of REITs are actually willing to own properties that have a WeWork lease, right? Because of that concern of kind of short-term versus long-term outcomes. So I think it goes back to, just because something is in a traditional market, even if it claims to be prioritizing financial value, that often if you ignore the social and environmental consequences, you're not going to maximize the financial value.
Right.
Right, and that's not a bleeding heart liberal thing to say. That's just reality.
Right. So let's talk about how you source deals and what you look for in a good social impact investment deal. Do you prefer to specialize in a specific niche in geography, or are your investments more broader based?
So at Camden Group, we're quite broad. We do about 70% domestic, 30% international, and we really also try, to not just invest in the coast, but to have investments throughout the country. We speak 6 to 7 languages throughout the team, and really try in general to invest in places where we do speak a language, and that means, part of that community accountability element is, can you actually communicate with the reported beneficiaries to make sure you're getting their candid interpretations and that it's not just all intermediated by the company. That's something that's also very important to us. And then we're very cross-sector because we believe that social innovation absolutely needs to happen in so many different areas of society, whether it's agriculture or housing or energy or education. It does mean we're also careful to not invest in things that we really can't understand. So we're not going to be, for instance, in the really deep end of the tech pool, for instance, in clean energy development. But once there are proven innovations, right, then we can be the ones to step in and scale them up.
Right. So would you say it's harder or more complex when it's more broader based, when you invest more broadly than like if you just focused on a specific geography and say just solar energy somewhere?
It definitely can be easier if you're, really right?
Right.
And will they take your call, and will they give you honest feedback? So I think that's really more than anything our expertise is keeping that wide network. And that does mean even if, you might miss some stuff, obviously. But the other thing that's so important in investment is diversification, right? So I would not want to only have investments in clean energy in South Africa, for instance, or in California, for that
Right.
matter. That you want to make sure that you have a really diverse portfolio that can weather different paths within the market. So I think that it's something that we see as core, not just from a social strategy perspective, but also in terms of our efforts to minimize risk.
Right. So what financial modeling tools or strategies do you use to gauge potential return targets?
So I would say that companies are always going to have a number of different desired endpoints, right? So if you're playing it backwards from an acceptable range of exit, right, which is that I'm looking to make a certain multiple of my money. Now, what's interesting, if I'm a venture capitalist, I might be trying for at least a 10x on every deal, right? What they look at is you want at least 1 or 2 unicorns per portfolio, and then the rest of your companies can flop and it doesn't matter. Social investors tend to think a bit differently, that we would rather have a broad portfolio with more doubles and triples than just holding out for the whole run. And that's also important because if you have a bunch of flopping businesses, that's not good for people,
Right.
in terms of whether it's jobs, stability, products in the market. So we want to have that longevity. We also know that those companies tend to be more sustainable. Not every business is trying to be $1 billion business, nor should it be. That if you have a particular regional or sector expertise, build the size company that's right for you. And we see often if people take on too much venture money, it's pushing them into a model that's not right for them.
Right.
So I would say that our financial underwriting is always built on what is this sector, what is this particular company, what is the desire of that entrepreneur? Do they want to stay there forever? Do they want to sell it? And therefore, how do I work backwards from that implied outcome or valuation to what is the type of growth that I'm going to need to see, and what's the likelihood that they're going to get there, right? So really trying to be realistic about what the market access and opportunity is.
Right. In your book, you mentioned you either go with high impact, high return, and you don't, for example, don't consider medium return, medium impact.
Got it. So one of the things that we know, going back to that idea that not every company is going to be a 10x company, but that some might be, a really reliable 3x company. That in the case where something is a lower return vehicle, I may be looking to make sure I'm getting the absolute most exceptional impact that I can, or I want something that's high return and high impact. If something is not that exciting financially or from an impact perspective, it might just be a bad investment, and I don't want to make it, right? So I think it's being very clear that there are times where we will accept a lower rate of return than what might otherwise be offered on the market, but that we're doing it for a very specific purpose, right? And that goes back to one of the initiatives we organized this year is called Real Money Moves, and it was working with a number of cultural influencers, NFL players, cast members of Orange is the New Black, who committed to keep their money out of the private prisons financing family detention, and then some collectively committed $10 million to social investing. And in that conversation of, well, if I do that, am I going to lose return? There is also this question of, well, hypothetically, let's say that you were making a 10% return by profiting from locking up children and separating them from their families, or you might make 8% through renewable energy. Which would you choose, right? And that sometimes we use this kind of arbitrary what the market says as if that is the gospel, as opposed to more of a bottom-up assessment of what do I and my family need, and if I have to harm someone else's family by supporting my own, do I want to make that trade-off, right? Like, could I actually look in my grandchildren's eyes and say, you know what, that 2% was more important to me than the idea of seeing other children like you separated from their family, right?
Right.
So I think there's a certain point where we have to redefine what the market means, and that the market has to be a place where we're actually taking care of our fellow human beings.
Right. And how would you define impact washing?
So impact washing comes out of the idea of greenwashing, which you may have heard of, which is essentially when companies were trying to show that they were on that environmental bandwagon, and therefore talking about things like clean coal, right, where there's no way to make clean coal. The whole point is that the fossil fuel is not clean. But by putting that label, right, it was a way to try to show that you're doing something, that you're painting it green, but it's not really green. And in a similar way, particularly as you're seeing more traditional financial institutions coming into impact who really don't have the history or the on-the-ground connections to know if that impact is real or not, can wind up sometimes calling something their impact portfolio, but then when you look under the hood, it just is kind of a reorganization of the Fortune 500, right?
Right.
So there's definitely been concern, and I think an opportunity for us to really be conscious consumers of impact investing, right? But if you get offered an impact portfolio, take the time to really go through and question that advisor. So why is this company being included? Or if it is, are you engaging in shareholder activism to try to improve its practices, right? So social change is always a work in progress. It's not that you're going to have the most beautiful, perfect portfolio on day one.
Right.
But are you really showing that progress and that commitment? That's what we have to safeguard against.
Right. You had an interesting deal on the Maya Mountain cacao deal. How did you come up with the deal structure, and what did you consider when conducting like financial due diligence, impact diligence, and negotiating terms?
So in the book, I talk about a number of deals that we've done, and one of them is now called Uncommon Cacao, which is an umbrella company for a couple of local entities, including Maya Mountain Cacao, that sources cacao from various countries around the world, and that's the primary ingredient in chocolate. An area where, you know, even if you buy that fair trade bar, the farmer probably only got 2 cents more. So still not livable, not sustainable, versus Uncommon Cacao that have been working to make sure that the majority of the value of any transaction was actually getting back into farmer associations. So in that deal, we really wanted to make sure to balance the risk and return across multiple stakeholders. So going back to what I mentioned about non-extractive finance, how do I make sure that the farmers are the primary beneficiaries while we also make an acceptable return? Because this is still a for-profit investment. And we're able to structure a deal that provided some ownership to farmer organizations, right? So they're not just the beneficiaries, but are actually the protagonists. And then make sure that there is meaningful input from a governance perspective for what these farmers actually want. So once again, we're not just deciding other people's futures for themselves. So that's been a really exciting company to get to be a part of.
Yeah, that was interesting. I like the way you spelled it out from start to finish, and I just was curious as to the financial structure. Like, I know there was a founder, a CEO, investors, and employees. Like, how do you structure the deal so that the founder and the CEO and the employees actually come out ahead?
Sure. So one is, I think you have to understand that every decision you make makes an impact on those different stakeholders, right? So really being clear, what is, for instance, the living wage in each of their contexts? What's the risk and return that each of those actors is taking on, right? There's ways in that, for instance, because the farmers are paid first, they have less risk, which is part of why they have less ownership than the founder. So really kind of evaluating what is everyone's relative contribution, and then are they getting a fair stake for that, and then that factoring in to how they actually structured the company. And that's one of the examples in the book that I really kind of go into in detail in how that got structured.
Interesting. So let's do a hypothetical. Let's say we're to take Uber private. It's currently public. We take it.
Got it.
So that's a company that is has tons of equity. They rely on a lot of drivers and their own vehicles, and they don't make as much money. I believe they make out less than minimum wage. So if we did a fun hypothetical, if we were to take Uber private and make it profitable, how would you restructure the company so that it would fit within your lens of impact investing?
Sure. So first, I would would be really thinking about, right now, one of the challenges in the rideshare space is that there is reasonably not a lot of loyalty on the part of the drivers. And I have to disclose that I guess recently the IPO happened, so that sort of is in process of being exited, but that I did support an investment in Lyft. Had betted on a different pony from that perspective in terms of specifically how they were treating their drivers. And noting that, you get drivers with much better loyalty when you're making efforts to treat them better. So I think that would be a starting principle, that the drivers are the backbone of the company, and therefore what do you need to do to make sure that their contributions are being addressed fairly, and then hopefully, right, that's going to be part of what brings more users onto the platform, and then when you get that network density, that's what enables the company to thrive. So it goes back to, it's not just about being the bleeding heart, but it's also looking at a business perspective. How do you get the most value you can out of your most important resource, which is the people.
Right.
So at any rate, coming from that lens, which would probably require a pretty radical reorganization of the company, I would probably start with some sort of living wage provision, because if I have drivers that can't afford their rent, that are driving tired and putting people at greater safety risk, then I'm not going to be successful. So I want to make sure that everyone reaches a minimum standard. And then I also want to make sure that they are loyal and contributing ideas for the company's success. So I would want to, kind of similar to Juno, be able to create opportunities for them to own equity, right? And to be able to buy in through their work, through their sweat equity, like anyone else in the company. So it's funny how in a traditional tech company, you would never dream of investing in a company that hadn't set aside significant equity for employees, because everybody understands that no tech worker who's worth their dollar would ever work without equity involved. So why would a driver be different, right? If given the option and given that motivation. So I would want to create significant opportunities for them to be able to work their way into that equity pool, and then shift some of the governance in the company to make sure that their feedback is really a substantial part of planning.
Right. And what's interesting is they're not only giving their time, they're giving their vehicle. They're basically running it into the ground, putting the amount of hours and time on the engine and just wearing it down. So they're getting a double whack there, both in the wage and their vehicle just depreciates much quicker. Yeah.
And I think that raises a lot of questions as to whether that's a sustainable model. It's sort of similar to fossil fuel extraction, the idea that if you have a fundamentally extractive relationship with your primary cash cow, right, then it may not be around forever for you.
Right.
So these are some of the pieces that we need to, really be a lot more intentional if we want to build a long-term company.
I mean, it's interesting you said you've invested in Lyft, because I was out in Austin, Texas, I think a year and a half ago, and I started using Lyft more than I started using Uber, and I was asking the driver, who do you like, because he had both emblems in the car. I said, who do you like driving for the most? He says, definitely Lyft, because they treat their drivers better. So it's like, that's pretty interesting. That was a good, interesting competitive advantage for Lyft to come into the market at the right time, because it enabled most of the drivers in Austin that I've dealt with either didn't drive for Uber or limited their hours with them. So that's interesting.
Yeah, and I think that's a point that's much broader than even the Uber Lyft debate, right? Which is just simply that if you treat people well, they will do better for you.
Right.
And how do you create those conditions? It's a very, very simple equation.
Yep. So what's been your favorite investment to date, either high impact or high profitability, or both?
I can't choose between my children. Too many of them. I guess there's just so many, and for so many different reasons. I love some of the funds like Impact America, founded by Keisha Cash, which has been working with entrepreneurs across urban centers who are serving low-income communities predominantly. And her entrepreneurs are primarily women and people of color as well. So really kind of looking at impact across that chain. I love the investment we've made in Macro, which is multicultural media. It's a massively growing market, and so important to make sure that people can see themselves reflected on screen the way that they want to be seen. And then we've also seen, films from Black Panther to Creed on down, how they've been tremendously profitable at the box office, right? So that also goes back to spaces where you can have great social alignment and great financial potential as well. So obviously the jury is still out on many investments. It takes time, but that's so far we are just so excited about what these investments are doing in the world. And even those last two stories, I think we're so used to feeling like financial management is this chore, that I have to check in with my financial advisor maybe every quarter, maybe twice a year. That may be a slightly uncomfortable conversation. I don't always know really what I'm invested in. And the opportunity with impact investing to have your quarterly meeting actually getting to hear the inspiring stories of the entrepreneurs and funds you've been able to support just creates such a different dynamic, right? And a real way to get excited about your money. So I'm excited every day with the entrepreneurs that we get to work with.
Well, I'm glad you have the ability to not be able to choose, because that's a good thing. Quick question. What would be some lucrative industries in the United States that would benefit from co-ops? You mentioned it in the book, but do you see any industries that would be ripe for co-ops within the U.S.?
My short answer would say that I think every industry is more ripe for co-ops, right? That you're starting to see, particularly a number of mid-sized businesses where, manufacturing or otherwise, where the owner is aging, maybe their kids don't want to take it over, and that there's the opportunity to transition to a co-op or even an ESOP, which can have tremendous tax benefits for that owner. So people are finding that that's an interesting solution to the succession challenge that we're having given the baby boomer phenomena.
Right.
So we're seeing lots of opportunity there and lots of people saying, if I can, get significant tax benefits from this and at the same time feel really comfortable that the workers who I trust, right, who I've worked with for 20 years or more, that they know how to run this business better than anybody because they've been doing it, and that they can continue on with my legacy, that becomes, quite the win-win for people. So I think we're seeing more and more opportunity and more recognition, going back to what I was saying earlier, that creating equity ownership opportunities just creates a much more committed team, so becomes a viable option in any number of sectors.
So there's a tax incentive to owners to engage in a co-op?
There is specifically for ESOPs. I'm less confident in terms of the co-op environment. There's a couple different ways that you can structure them, so it sort of depends on the individual situation. But essentially, you're able to make transfers tax-free in the ESOP environment. So there's really strong incentive because it's essentially it's funding a retirement plan.
Right.
How ESOPs work.
Okay. Good to know. So let's switch to opportunity zones. Opportunity zones are supposed to rebuild over 8,000 U.S. communities that seem to get left behind during every economic expansion. And the New York Times recently wrote an article criticizing the program as a tax loophole for the rich. And since most of the Opportunity Zone investments have been made in luxury hotels and property developments, what should community leaders do to get investors focused on investing in deals that can actually uplift communities through social impact investing, rather than the typical hotel and real estate deal?
Sure. So I think it's really critical to mention, the name Opportunity Zones, I think, tends to imply that it's always going to create some beneficial opportunity for that community, and that is just not a given, which is why investors need to be extra vigilant when they're looking at Opportunity Zones to ask the right questions. So, for instance, the jobs that would be created through construction or otherwise, are those living wage? Are those actually going to local people, or are they coming to people from the outside? That's extremely common in the construction industry. And then also, whatever is going to be built, is it something that is accessible and affordable for local community members? So one of the things that's been interesting is how some projects that were already approved prior to the Opportunity Zone legislation getting passed are now getting grandfathered in, or getting those tax benefits. And that includes things like a Ritz-Carlton in Seattle, which is a mixture of hotel and luxury condos, right? And it's hard to imagine that in that opportunity zone, that lower income people would be moving into those luxury condos, right? So if anything, it's actually displacing downtown real estate that could otherwise be used for more affordable housing. So that is where you start to see the potentially nefarious side. And, definitely would love to see the government create more clear guidelines around the use of that. You've seen that recently in California, actually, and Newsom have looking at limiting opportunity zones to low-income housing and green energy infrastructure. I think it's important to also include local small businesses, minority-owned businesses as part of that as well, because people do forget that you can do equity in businesses, not just in real estate, as part of opportunity zones. But at any rate, it's just to say that there needs to be further guidance on how to make opportunity zones responsible, or with the lack of guidance from the government, the onus is really on local investors to be choosing how they want to show up as a community member and how they want to be remembered for their legacy.
Right. I've seen a lot of vertical farming being pitched at certain investor events. It seems to be a hot sector of urban America. If you were considering investing in a vertical farming startup, how would you want to see these startups structured for social impact? Because a lot of them have mentioned that they're targeting the urban cities like Austin and Brooklyn, and to help local communities by paying higher wages and by bringing like decent paying jobs like this to the inner city. How would you? So if you were going to invest in a vertical farming startup, what questions would you ask, and how would you like to see them structured?
Sure. So I think it's a great example of, Candide Group, we often talk about the difference between the what and the how. So, the what might be the farming generally, or vertical farming, or, some industry that on the surface sounds really positive, but then the how is really critical, right? Of how are they doing this? And how does that impact local residents, or otherwise? How does it impact the environment? So when they're creating jobs, are those living wage jobs? Who are they going to? Does it match the demographics of the neighborhood historically, or is it more causing people to move in and displace? Is a major question that comes up. Then it also can be the question of who is the produce going to, right? Like often, particularly vertical farming, tends to be microgreens, the type that you would get in the clamshell for $6 a pack in a Brooklyn store, right? And who is that affordable and accessible to?
Right.
And are there ways that you're able to make your product really accessible to people who do not have as stable food access, and particularly access to produce and healthy food? So those are some of the questions I would be asking.
Great. Now, if there's an entrepreneur out there listening and is interested in setting up a social impact business in the United States, what sectors do you see that need the most attention? Where would you direct entrepreneurs right now?
I think in general, it's where, there's so much work that needs to be done that it really is more about what is the expertise of that particular entrepreneur and where can you apply it, right? So if you have an engineering background or a mechanical background, or are a school teacher who sees an opportunity to really expand within the education field, right? So it always is this, what do I know, and then where can I add value based on that, and what are the communities that might lack the sort of skill or opportunity that I could potentially be providing. So I think if anything, entrepreneurship is a tough road, and that means that whatever you choose has to be something that you are just deeply, deeply passionate about, right? I think people often forget, particularly if you're going to raise money, the expectation is that you are going to do your darndest to be around that whole time, right?
Right.
That you're essentially making a 10-year commitment. And sometimes, certainly for young folks, that may be the longest they've ever conceptualized doing anything. And that it means being prepared for that commitment is really critical, and therefore it means certainly you want to be responsive to what the world needs, right? And how do you make sure to evaluate that responsibly? But it definitely has to intersect with where your skill set is and what you're passionate about if you're going to really stick with it in the long run.
Well, given that question, we could go into where it could be rooted from. And you mentioned that social education is not being taken as seriously as financial education. How would you design a social impact curriculum to encompass the most important aspects of impact investing? Because some entrepreneurs might be interested, but they might not have the depth to pick a direction. So how would you basically put together a curriculum on social impact?
So I think first and foremost, really, even if we're getting the specifics of the curriculum, it's just making that commitment, right? In the way that people might feel, well, if I'm an entrepreneur, then I have to go to business school, or I'm going to go to an investment bank first, and I'm going to spend those, 4 years or whatnot, getting that education and making sure I'm fully qualified. And then when it's time to decide what social change is, well, I can just read the newspaper and that'll be good enough. And that's literally an answer that I've heard sometimes from investment managers in terms of them saying, when I've asked the question of, well, how do you know what the world actually needs, right? Like, what's your data sources for that, the same way you would collect other data towards making investments. So I think one, in order to kind of make sure you're getting that data, you really have to make a commitment, and that means time, right? So we really block out time on our team to make sure that everyone has the opportunity to get out in community, that they're getting that sort of direct feedback and kind of keeping their eyes open and having significant relationships in community. And sometimes that can really result in things you never would have expected. So for instance, there was a fire a couple of years ago in Oakland that decimated about 300 housing units for largely low-income Black community members who it also had a number of special needs cases. So very, very difficult to replace that housing. And there was a church that was organizing the relief efforts in West Oakland, a Black church. And I told the team, okay, we're going down. And spent pretty much every day there that week. And was also the opportunity in folding clothes and getting to know community members to be building those alliances, not even necessarily knowing if that would lead to a certain outcome. But then it turned out that some of those churches had these parking lots that they were no longer really using and were excited about the idea of developing housing. And we were able to connect them with a low-income housing developer to start working on some projects, right? So that's the type of thing where I never would have gone into that thinking it would be a business relationship. But the fact that we invested that time in community really led to a positive outcome. So I think you have to be open to spending time on community connections, even if you don't know what the immediate outcome will be. So that's point number one. Point number two is to really think about what are the venues where our grassroots communities are gathering, right? So in the way that you might go to a private equity conference or entrepreneurship or whatnot, can you find similar opportunities within the social sector, even if people are looking at you funny and saying, well, you're an investor, what are you doing here? And it's like, well, that's precisely what I'm doing here, right? I want to make sure that I'm really integrating and thoughtful. And in the book, I definitely give some examples of the types of conferences and forums that we have been spending time in, whether it's racial justice or housing or energy or whatnot, to make sure that we're really hearing from voices all over the world. So that's some of the ways that I would be thinking about it. It's really about putting yourself in the path of people who are doing innovative work.
Great. That's great information. And on the investor side, for those who are listening and are serious about investing in impact investing, where's a good source to find good social impact deal flow?
So if you're looking for direct investments, right, then there are those networks like Tonic and Investor Circle that can help. And they generally are just providing the pipeline, right? So then there still is the diligence, the execution, the management, and that's where managers can be really helpful. Looking for an impact investment advisor who can help to manage that process for you and help you figure out what your portfolio is going to look like. So I think it's important, to decide how much of your life do you want this to take over, because as an individual investor, it's very easy to get caught up in companies, dealing with amendments and reports and whatnot, and all of a sudden it's your full-time job. And if you don't want it to be your full-time job, but you still want to, get to have some exposure to it, support companies, a lot of ex-entrepreneurs that want to, they may enjoy the experience of serving credit through banks, but they actually want to use their business skills, right, as the basis of their volunteering. That this is a way to kind of create those access and opportunities in working with an advisor, but not have to be doing all the day-to-day all the time. So there's lots of different kind of entry points to the industry.
Any conferences in particular?
So SoCap is coming up in the fall, and CoCap, which are both in the Bay Area. I will definitely be speaking at SoCap, and I'll be there with Derek Morgan, an NFL veteran who we've been working closely with on his impact investment portfolio. There's so many, and in general, the GIN, the Global Impact Investment Network, GIIN.org, tends to have a pretty good running calendar of what are the conferences happening in the space.
Right, that's great information. Again, Morgan Simon, thank you so much. I wish you could replicate more people like you who do so much good in the world. I'm a big fan of you and your mission. If you haven't picked up her book, Real Impact, go get it on Amazon today. The book is a must-read for investors and entrepreneurs looking to make a real impact in the world. Thank you so much for coming on the podcast. It was a pleasure.
Thank you. Likewise.